This video is brought to you by Brilliant. Yesterday, the Office for National Statistics announced its inflation figures for May. Unfortunately for ordinary Brits and Prime Minister Rishi Sunak, year-on-year headline inflation in May came in at 8.7%. The same as it was in April and significantly higher than the 8.4% that analysts were forecasting. So in this video, we're going to have a look at why inflation just won't come down, how the UK compares to other countries here, hint, not well, and why this is truly terrible news not just for the UK economy and the housing market, but also Rishi Sunak. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. So let's get straight into yesterday's data. As we mentioned in the intro, inflation came in at 8.7%. The same as last month and significantly higher than expected. This means that prices actually rose by 0.7% between just April and May, and the increases were apparently mostly driven by an increase in the cost of certain leisure activities, including airfares, package holidays, live music events, games and toys, and yet another increase in the price of food. While year-on-year food inflation came in at 18.3%, which is significantly lower than the 19% we saw in April, this is still stupidly high, and it implies a monthly increase of 0.9% between just April and May. We did a video on this just a couple of days ago, and the TLDR was that, while the rest of the world is also seeing steep increases in food prices, the UK has been particularly badly affected, and this might have something to do with Brexit. Anyway, to make matters even worse, year-on-year core inflation actually rose from 6.8% in April to 7.1% in May. Core inflation basically strips out commodities like food and energy prices from the headline inflation rate, because those things are more volatile and are mostly determined by international factors. In doing this, core inflation aims to evaluate whether domestic demand is too strong, and it's one of the key things that central banks look at when deciding whether to hike or cut interest rates. This makes the UK a global outlier in both respects. In the rest of the developed world, both headline and core inflation are falling, which is exactly what central banks intended. Across the EU, for example, headline inflation fell from 8.1% in April to 7.1% in May. In the US, headline inflation fell from 3.8% to 2.7%, and core inflation has basically been falling since September of last year. Now, sometimes economic news can feel a bit removed from what we might describe as real life, but this really is terrible news for ordinary Brits. For starters, rising prices are bad news in and of themselves, not least because UK wages aren't growing as fast as prices are rising. UK wages have been basically stagnant since 2008, and while they've started going up a bit recently, with year-on-year private sector wage growth coming in at 7.4% in April, that's still below inflation, which means Brits are still getting poorer in real terms. But the other reason this is terrible news for ordinary Brits is that it'll probably mean further and steeper interest rate hikes from the Bank of England. Obviously, because we're writing this video on Tuesday, we don't know what the bank has announced today, but the markets currently expect either a further 0.25% hike or possibly a 0.5% hike, which would take the bank rate from 4.5% to either 4.75% or 5%. This would be the highest since April 2008, and markets actually expect the bank to continue hiking rates for the next few months, before peaking at about 6% at the beginning of next year. To make matters worse, the markets have consistently underestimated how much the bank has actually hiked rates, which means there's reasons to expect that they could go even higher. Now, interest rate hikes are obviously bad news for ordinary Brits, because they make borrowing money more expensive, but the problem is particularly acute in the context of the UK's mortgage crisis. As we've explained in a previous video, many UK homeowners are on, or are about to move on to, variable rate mortgages. The cost of these mortgages depend on the current interest rate, so as interest rates go up, the cost of servicing those mortgages has also gone up. Your average mortgage already costs nearly £3,000 more a year, and this number is only going to go up now that the bank has had to hike rates further. Not only will this put downward pressure on the housing market, but if things continue to get worse, we could see a wave of repossessions akin to what happened in the early 90s, when nearly 200,000 homes were repossessed by lenders. Even if you think a fall in house prices is fundamentally a good thing, and well, it's hard to deny that houses in the UK are too expensive, You still have to admit this is going to be a miserable time for poorer UK homeowners. All this is also terrible news for Rishi Sunak. Even if this isn't really his fault, after all, the Bank of England is actually responsible for inflation, all this turbulence will completely undermine his claim to economic competence in the minds of most voters. It also doesn't help that he's made halving inflation by the end of the year the first of his 5 key pledges. At the time, this looked like a politically savvy move. Most analysts thought that inflation would come down by itself over time as energy and food prices fell across the world, and Sunak could take some credit for it. However, inflation doesn't look like it's going down anytime soon, and if it does go down, this will probably be a consequence of steep rate hikes from the Bank of England. By making it more expensive to borrow or service debt, these rate hikes aim to take money out of the economy, and one of the foreseen but unintended impacts is causing a recession. What we're trying to say is that if inflation does halve by the end of the year, as Sunak pledged it would, it'll probably require an interest rate hike-induced recession. Unfortunately, the second of Sunak's 5 pledges is growing the economy, which means he's almost guaranteed to miss at least 1, if not 2, of his 5 key pledges. In yet more bad news for Sunak, the rise in interest rates has pushed up government borrowing costs to mini-budget levels, and Sunak's third pledge was to make sure our national debt is falling. This was always going to be difficult, and it's going to become more difficult as borrowing costs rise and the political pressure builds on the government to provide some sort of relief for affected homeowners. So, all in all, things aren't looking great for ordinary Brits or the Prime Minister. But having watched an 8-minute video explaining the intricacies of the UK's economy, it's fair to say you have a desire to learn and better your knowledge of politics and economics. Well, we've got something that you might enjoy and will continue your online educational journey. Brilliant. Brilliant is an online STEM learning platform where you can learn everything from quantum computing or algebra to logical decision making. And if you don't want to learn more about the world from simply just watching YouTube videos, then you're in luck, because Brilliant actually teaches you by doing, using active learning techniques to teach you the principles behind otherwise complex subjects, and ensuring you actually understand what's going on. And rather like a good TLDR news video, Brilliant breaks topics down into accessible chunks, which you can work through whenever you have time. There's no homework, there's no deadlines, and there's no core classes. You can spend anything from a few minutes to a few hours a day accumulating new knowledge in an actually fun way. So, whether you want to brush up on your basic math skills, improve your employment prospects by learning about future technologies, or just have fun with coding, you can check out everything Brilliant has to offer free for a full 30 days. Click on the link in the description. Plus, the first 200 of you will get 20% off Brilliant's annual premium subscription. Thanks for your support.